Hey guys, welcome back to week 5. We're covering chapter 7 and 8 this week. We're really going to be talking about risk, return, and the cost of capital. So, chapter 7 deals with risk, return, and the opportunity cost of capital. So, when we talk about chapter 7, when we talk about expected return, this is the average return an investor anticipates over time from a security or a project. So if a stock has a 60% chance of returning 8% and a 40% chance of returning 4%, so then we'd have to come up with a formula to calculate, what is the likelihood of the return. And so you would have it's sort of like a weighted average. Your expected return would be 60% times the 8% plus the 40% times the 4%. And then you average it together and you get a 6.4% average return. So that is how you get sort of an expected return. Then there's risk, which really measures how to spread out possible outcomes, how spread out the possible outcomes are from the expected return, sort of like a standard deviation. So if there's a high standard deviation, there's more uncertainty, and it's used as a quantitative measure of risk itself. So it's a way we can quantify what risk actually is. And then when we really, the way that we help offset some of the risk, it would be diversification. So this would be combining assets in a way to reduce our overall risk. It works because asset returns are not perfectly correlated. Um, Only unsystematic risk or firm-specific risk is something that you can diversify away from. There's certain risks you can't, like economic factors, and there's things that are beyond your control. But what you can control, you try to control and diversify away from. Um, and so ultimately, that's really what we're trying to do. It goes back to the biblical, principle from Ecclesiastes 11, where it talks about investing in 7 ventures or 8, but it's that idea of diversification. So there's market risk and there's unique risk. So market is systemic risk, and it affects all firms. That's like inflation or recession. There's really not a lot you can do about that. But the unique or unsystematic risk would be risk that affects a single firm or industry, like a leadership change. So only market risk is rewarded with higher returns. Um, when we talk about the opportunity cost of capital, this is the rate of return you forego by investing in a project rather than the next best alternative of a similar risk. So, what's important on opportunity cost of capital? Opportunity cost is not like, hey, opportunity cost could be like, hey, I spent time studying for this test, so I didn't go to the movie, or I didn't work out, or I didn't sleep in. It's not all that. You couldn't have been 4 places at the same time. It's like your money. It can't be 4 different places. You have a choice, and you rank all the things in order that are important to you, and then you say, "This is my investment," and the next one that I gave up, number 2, that's my cost. Okay, that's the opportunity cost of capital. It's not all the things, but it's number 2, and so it is the discount rate for calculating your net present value, and it's based on the project's risk, not the company's average risk. So if a project is risky, as the stock market, use the expected return on the market, like a 10% discount rate. And that's really what you're trying to do here. So chapter 8 deals with risk and return, and like your portfolio return. So you may have like a lot of different stocks that are part of a portfolio. And all that helps to spread out risk. And when you look at the portfolio return, you're really looking at the weighted average of the returns on every asset in the portfolio itself. So sort of the idea of expected risk, now you're looking at the return throughout everything, and you're getting like an aggregate return or total return for a set of stocks. When we talk about portfolio risk, this really depends on the variances of the individual assets and their correlation. So if the correlation, how they're integrated, how they're related, um, that correlation is less than one, it reduces the overall risk of the portfolio. But when you combine risky assets, it can actually create a less risky portfolio because you've got things going in opposite directions. The idea of risk and managing your portfolio is trying to get something that has a consistent return, regardless of what the market's doing. You have certain, like Berkshire Hathaway is a great example of that, Warren Buffett's company. But the idea that you diversify in such a way that you make money on the good or the bad times, that's really what you're looking for. So we talk about beta. This is a measure of an asset's sensitivity to market movements. So uh, if the beta equals 1, it's the same risk as the market. If it's greater than 1, it's more volatile than the market. Or if it's less than 1, it would be less volatile than the market. So if Tesla has a beta of 1.8, if the market rises 10%, Tesla may rise 18%. Then there's the capital asset pricing model, CAPM. This is a model that that relates expected return to systematic risk or beta risk, and that is, so for instance, you've got your risk-free rate, you have the expected return of the market, and the assets beta. And here you're just trying to figure out what your expected risk would be. If the in this example here, if we end up saying that you have a beta of a risk-free rate, if that is 3%, and your expected return on the market would be 1.5%, and your beta is 9%, you would take the 9% minus the 3%, and you'd multiply that times the 1.5%. Then you'd add it back to the risk-free rate of 3%, and it'd give you about a 12% expected return. So there's a security market line as well, SML. This is a graphical representation of the CAPM, and it shows the relationship between the beta and the expected return. So projects that are above the security market line are undervalued, but projects that are below the SML are overvalued. There's alpha, and this is the difference between the actual return and the expected return that's predicted by the CAPM. So if alpha is greater than 0, the asset outperformed, and if it's less than 0, the asset underperformed. There is also the cost of capital, the return a firm must offer in order to compensate its investors for risk. It's used as the discount rate in capital budgeting, and it can be based on the company's weighted average cost of capital, WACC, or the project-specific rate from the capital asset pricing model. Ultimately, in Proverbs 21, obviously this is a book of wisdom, but it tells us that the plans of the diligent lead surely to abundance. So diligently understanding the risk and the return is going to be key to wise decision making in life. You have to, they say people don't plan to fail, they fail to plan. Looking at factors before you invest. This is why this is important, especially in a large organization where a lot of families depend on your ability to make good financial decisions so that they continue to have a paycheck. Anyways, guys, if you have any questions, need anything from me, let me know. I'm always here to help. Thanks, and talk to you guys soon.